let's get right into it, everybody. So as always, if this is your first lecture, I'd like to welcome you to the lectures here at OOT. Just to introduce you to myself, my name is Tostie. I've been giving lectures here at Only Options Trades going on, wow, I think almost 2 years, maybe? Almost 2 years. Actually, no, almost a year and a half. So been giving lectures for a little while, so I'd like to think I have a decent amount of experience. So yeah, that's a little background into me. So just to give a few remarks before I get into the lecture, just to talk about my style and how I like to cater to the students. Big picture in the market, there's a lot of information to digest. In my lectures, I like to present the information in a manner that increases the difficulty as we progress through each individual lecture. Just like you guys are all today, some of you might be brand new to the market, some of you might have a little bit of experience, but I was in each and every one of your shoes at one point in my life as well. So I know what it's like to be in the learning chair and still do. So I do my best to cater these lectures to a new trader in some ways. And I also try to give points that give bigger picture and help you build on that kind of new trader knowledge and allow you to grow into a more advanced trader and to be able to use that big picture knowledge and apply that to other concepts. So again, right, all these lectures are going to be very information dense. I try to cater to a lot of different learning styles as well, visual learners, auditory, people who like questions and answers, examples, all that good stuff. So it's a very diverse class we have here each and every week. So it's hard for me to, make it perfect for everybody, but I do my best. So if there is any suggestions for the class as we continue on throughout, I would really, truly love to hear them. Because again, this class is for all of you. So the more suggestions I get, the better I can make it. It's been, a little while I've been doing this class, so I'd like to think it's relatively refined. However, there's always room for improvement. So that's kind of big picture, how I like to teach, how these classes work. And as some of you all know, this is a class tonight that's going to be part of a bigger series. And I'm going to give you a little bit of what that series looks like. So typically in the past, this series has been a 4-part series. And I've grouped these 4 classes together, which are more based on kind of analyzing the technicals of the market. So looking at charts and understanding that aspect of the market. What I'm trying to do now for the first time ever is to expand this course series to be a little bit more sequential, to start somebody from the absolute rock bottom, and not in a bad sense, but like, absolutely nothing, and build you up from there. So this is just going to be part of the course series, but this is kind of the bulk of the information. So we're not starting here tonight. We're starting with the basics of options. We're going to talk about how they move, what they mean, what they represent, how to understand them, all that good stuff. But the ultimate goal of this course series is to turn each and every one of you who attend week in and week out into a successful trader who can find the highest probability trades and act on those opportunities with confidence. And that's my motto for this course series. And I'd like to think that we've been pretty successful in making this happen each and every time we've repeated it. So I'm excited to welcome this new group of members into the class this time around. And as always, guys, this class is for you. So if you have any suggestions after we complete this class, I would truly love to hear them. And yeah, just to give a brief background, today, we're going to start with the basics of options. If you are looking for the PowerPoint that I'm going to be following along with, you can find it right here. You can download the PDF with me and follow along. Before I get into the basics of options, I'm going to give just a quick background into understanding my watch list, because as we progress through this course series, I think this watch list will be a nice reference for you all to kind of follow along with and use as, I guess, a reference for your own learning. So again, not expecting everybody to understand what everything in this watch list means. I just want to show you around a little bit and give you just a very brief introduction to kind of how it works, what I like to do when I'm scanning stocks in the market. And this also will help to give you kind of a purpose for being in this class, because ultimately, right, I want each and every one of you to be in here, or each and every one of you that are in here to be able to develop your own watch list, analyze the stock market on your own. So you don't need other people to rely on. So you can do this all on your own. You don't need to be in this group, because the whole point is to train you up and get you out of here so you can go trade on your own and, maybe teach other people in the future. So I want to just show you kind of how I scan stocks and how I convey my thoughts and information to everybody in the server. And I'm just going to give a brief introduction to that. And I think Moon, your audio is probably, check your audio. All right, so I'm just going to show you where to find my watch list very briefly. Again, I don't want to take too much time on this because this isn't the main intent of this class. Just to show you guys around a little bit. So trade floors here. This is where we kind of do a lot of the talking during market hours. My tab is right here, this Tostie Ideas tab. And I'm just starting out a new format for my watch list. So if you click on this link right here, it'll bring you to my watch list. And big picture, what we're seeing here is I like to give kind of my thoughts, the things that I'm seeing on each individual charts. I talk about some key levels where I'm looking to trade specific stocks, a chart for your reference so you can zoom in and look at that in more detail. And then that's pretty much big picture, right? So you can see the instruments that I'm referring to, specific names that I'm focusing on for the week, and other, flow perspectives, what the option market is pricing in. Now, again, really want to keep this brief just to show you that you can find this, you can use this as a reference in your trading while you're here. But again, not going to talk too far in detail because I'm taking the assumption that nobody knows a single thing that I'm referring to in this watch list. So as we continue to develop our knowledge throughout these classes, this watch list will continue to make more and more sense for all of you. And again, I hope it is a good technical reference to show you kind of just some things to look at, my perspective in the market. Again, I'm not perfect. There's many, many ways to look at the market. It's just kind of me showing you how I think, and maybe it gives you an idea of maybe how you can develop your own thoughts or develop into your own trader. So again, that's big picture, the things that I wanted to talk about tonight. Before we get into the lecture tonight, we're about to start the content. Does anybody have any questions on overall format, questions for me, questions on how this course series will work? Any specific questions regarding that before we get into the content, or is everybody kind of ready to just get moving? What are you guys thinking? How's everybody feeling so far? How long is the course? This one's going to be 8 weeks. And yes, this is going to be recorded. I think it's going to be posted tonight. I got to follow up with somebody about that, but I think it's going to be posted tonight. You don't need to follow the slides. It's just if you prefer to, you can. Is it going to be only Mondays? Yeah. So my lecture, I typically teach on Mondays or Wednesdays. So I'm going to be the person who's facilitating this course series. I'm going to bring in some guests as well. But for the most part, this is going to be me leading the course series. There's going to be other analysts and lecturers who are going to come in and provide different classes throughout the week. Like if you refer to the lecture schedule, I think we got a charting class tomorrow and like a Q&A on Wednesday. So those are not going to be led by me. Those are going to be led by other analysts. And if you're looking to refer to this lecture in the future, you can take a look at the bottom of the Discord way down here. It's going to be likely in this beginners tab. And we're going to put it down here, I think by tonight. I shouldn't give a deadline because that might not be true, but it's going to be posted soon. And one more thing, apologize if you guys hear me like sound sick. I have some allergies. So I feel fine. I just have allergies and those are kind of bugging me. So if I randomly mute, it's probably because I'm sneezing or feel like I sound weird. So yeah, that's everything. It seems like that is everything. Any other questions? Better than COVID? Yeah, Tilio. Definitely better than COVID, certainly. Tequila will fix that. Yeah, I'm trying to stay away from that. I got a wedding to go to the end of this week, so I think I'll probably save it for then. All right, cool. Well, let's get into it from here, everybody. So here's what we're going to talk about tonight. 3 main topics. We're going to talk about what are options. So we're going to talk about the instrument in general, how they work, kind of what they represent. Then we're going to talk about the Greeks. And the Greeks are essentially properties of an option contract that define how they move. And they can be very useful into selecting an option contract, which we're going to talk about in the 3rd section of tonight's lecture, where we talk about general rules on picking option contracts for your trades. And again, big picture, this is going to be a relatively basic lecture. This is just to get new traders up to speed so you guys can understand how options move. Because assumingly, a lot of you guys are in here to trade options, and it's very important to understand how they move because a lot of new traders get really burned not understanding how options work. So everybody who's in here is doing a great first step into their trading journey, just understanding the actual instrument that they're trading. So with that being said, let's start talking about what options actually are. So a lot of words coming up on this slide, but here's big picture, main types of options. So some of you guys might have seen, some of you guys might not have seen, but there's 2 types of options. There's call options and there's put options. And call options typically gain value when the stock price increases. So for example, if I'm trading Apple call options and Apple goes from $150 to $200, I'm going to make money on those call options. I add a qualifier in here typically because there's going to be some caveats to this. Our stock doesn't need to just go up for our option to gain value always. There's going to be some interesting scenarios where that's not actually what happens. But for the most part, just to start us all off, let's just assume that as a stock price increases, our options are going to gain value. Let's start with that fundamental rule. And same thing on put options, except the opposite. Put options typically gain value when the stock price decreases. So for example, let's go back to our Apple reference. If I'm trading Apple stock at 150 and I get a put option and then Apple decreases to $100, so it drops $50, that means my put option will go up in value. So a call option, you're looking for the stock price to increase, and a put option, you're looking for the stock price to decrease. And just a little bit of a graphical representation of how a call moves. So for example, if the stock price, okay, actually this is a little bit more confusing than I wanted it to be. So I'm probably going to stay away from this right now because it talks a little bit about some things that we haven't referenced yet. So I'm going to keep that off for now. Let's just keep it really, really basic. Call options, I make money when the stock price goes up. Put options, I make money when the stock price goes down. That's big picture how the options market works. And option contracts have some fundamental properties to them. So in this Discord, for the most part, you're going to see us trading options contracts. So essentially, we like to buy option contracts at a price and sell them for higher, right? We're just looking to make profit on those option contracts. But options actually exist for a reason besides just looking to make profit. Well, I guess this is kind of part of it. So options are historically a way for stock investors to protect themselves. So they're going to use these options to essentially, quote unquote, hedge, which is kind of a term of protecting yourself or buying insurance on undesirable moves in the stock. So a call option gives the owner of the contract the right to purchase 100 shares at the strike price. So for example, if I purchase a call at $50, and I'm going to actually pull up a chart for reference here. Let's pull up a simple chart here. Not expecting everybody to understand what's going on here. So don't worry if you have no idea what you're looking at. I'm just using this for those that are more visual learners. So let's take a look at this. Let's say I buy a call option at this green oval right here, which happens to be at $380. Currently, the stock is trading at $395. So if I bought a call option with the strike price of $380, and you're going to learn about what strike price means in just a second, and the stock increases to $395, I can use that call option. I can exercise that call option to purchase 100 shares at this $380 price. Now, you can imagine how that might be advantageous, right? If I'm thinking maybe the stock is going to go down, but I have a small, chance in my mind that the stock is going to go up, I could use that call option to protect myself. So if the stock does go up, I can purchase shares at the strike price of my contract and almost be in profits initially, right? And again, there's going to be some caveats to that, but just for purposes of simplicity, let's just say if my strike price is 380 and the current stock price is 395, if I exercise that contract, I'm going to be $15 in profits. So hopefully you guys can all see how that can be a little bit of an advantage if you're trading shares, right? It'd be nice to use these options to instantly be in profit if you exercise that contract. And obviously you have to pay for that contract up front, so it's not free. And there's going to be a few more kind of things to watch out for. But again, starting super basically, that is just big picture why options exist, kind of their fundamental purpose. But again, in this Discord, for the most part, we're not exercising options. We're mainly buying and selling the options before their expiration date to make money on simply the contract. Because you can imagine, if you are purchasing 100 shares, it's going to take a good portion of money. For example, on a stock like SPY, if I'm trying to purchase 100 shares at $395, that's going to take $39,500. And I'd like to assume that most people don't just have that much money to be throwing around on some options, well, I guess some shares. So that's kind of big picture why options exist, what they do, and how they move. So here's another kind of graph on how options exist or work. I'm not going to focus on that too much. I'm going to look to these next graphics. So again, one more thing that I want to point out is the stock market is a one-to-one game. If I'm buying an option, somebody has to sell me that option. It doesn't just come out of thin air. And the same thing goes if you think about the real world, right? If I'm looking to buy a PlayStation 5, somebody's got to sell it to me. It doesn't just appear, unless you think that Santa's elves are just making it appear, right? But big picture, if somebody's buying or if I'm selling the call, somebody's got to buy it from me, right? It's the same thing in real life. It just applies to the options market and the equities market as well, right? So if I'm looking to buy a share, somebody has to sell it to me. If I'm looking to buy a contract, somebody has to sell it to me. And exactly, it's a zero-sum game, Salem. So This just kind of shows the exchange between a call buyer and a call seller. So what we discussed just very briefly, we talked about exercising. If a call buyer exercises their call option, they receive stock, right? Because you're paying that 39,000 if you're buying the 100 shares of SPY. So they're exercising their call option, they get stock, right? And the call seller has to provide that stock, but receives the strike price, right? So if you're selling the call, you get the money that you sold. And if you're buying the call, you're giving that money that you sold and also paying for the shares. And the call seller gives up the shares. But does that kind of make sense? I know it might be really obscure and we probably just went through a lot of information really quickly. But are these concepts somewhat making sense so far? I know it's a lot. Like I said, okay, this is an interesting question. How true is the theory of option sellers being more successful than option buyers? That's an interesting question. There's no absolute in terms of success in the market though. Like, for example, an option seller could be completely horribly non-successful, just like an options buyer could be completely non-successful. It's not necessarily determined by how you are positioning your portfolio that determines your success. It's mainly, I guess I shouldn't say that in specific, but mainly success in the market is determined by your specific trading strategy, and it could involve call selling, call buying, among a bunch of other strategies. So big picture, I wouldn't say that call sellers are more successful than call buyers, absolute. However, it is important to note that typically hedge funds are the ones selling the bulk of options in the market, and usually they sell them to make money on them. And the big fish in the market typically don't let things go against them. So I guess if you're thinking from that perspective, it is kind of safe to assume that call sellers might tend to be a bit more profitable than call buyers, considering some aspects of the probabilities of profit are in their favor more to an extent. But again, there's no absolutes in the market. You can never necessarily say that one strategy is always more profitable than another. It's just there's always somebody who's going to disprove it. So I can't necessarily answer that question with a yes or a no, but hopefully that helps. I would say the most successful people typically use a mix of strategies, whether it's different types of trades or call buying and call selling, or share buying and option buying, or whatever it might be. But typically people use multiple strategies, and that's what drives their success, because there's different strategies that make more sense in different market conditions. Does that answer your question? To me, it sounded like a deal being made, if that made sense. Like, here's your offer, do you want it or not? Kind of, yeah. There's a few more like caveats to that. Like, for example, if I'm a call buyer and I'm exercising my option contract, there is no do you want it or not. It's I'm exercising my contract, give me my shares. So in that sense, it is kind of not a deal. It's you already kind of made the deal, but now it's like, hey, I am doing this. And I think this graph might help make that a little bit make sense a little bit. So and maybe I'm understanding your question a little bit incorrectly. So big picture, when I purchase an option contract, I'm buying the right to do something. And if I sell an option contract, sell to open, I'm giving up the right to do something, right? So here, how it's worded is, for example, if I'm a call buyer, I have the right to purchase stock if I exercise my contract. If I'm a call seller, I have the obligation to sell the stock if assigned, aka if the buyer exercises. So that is just kind of showing that the second you sell to open an option contract or buy to open an option contract, you are receiving that right or that obligation. It's not a choice once you're in that contract. And again, when you buy options, you don't have to exercise it. That is in no way forced upon you. It is completely your choice. You can buy and sell options completely freely whenever you decide. But yeah, if I'm holding that option contract through the expiration, then if I have the money, it is my right to purchase the stock if I'm exercised or if I exercise. Does that kind of make sense? Hopefully that makes it a little bit more clear. I think you have the right idea though. And again, I want to also make it clear, if I purchase an option contract, which is 99% of the things that you see in this Discord, selling it is not the same as selling to open. So there's selling to open an option position and there's buying to open an option position. And again, 99% of what we do in this Discord is always buying to open. When we buy to open, all we're looking to do is essentially buy an option contract at say $500 and sell it at, let's say, $600, right? We're looking to make money on that and sell it for a profit. Selling to open is a completely different strategy where you either need to have a large amount of capital or you need to have 100 shares. So that is a completely different topic that we could talk about for a whole nother lecture. So try not to focus too much on that. I know it might be kind of leaving you hanging a little bit. But yeah, can I explain going through it visually? How could I explain this visually? Let's think. I might, let's see. Maybe this graphic will help a little bit. So we're going to learn about some properties of an option contract, but let's just ignore that we don't know what this means, right? So let's say my call option gives me the right to exercise it and I can purchase shares at $100, right? So let's say I have a call option and the right, or my privilege when I purchase that call option is to, yeah, exactly, Rick. I think actually, yeah, let me do that really quick. Let me explain the different properties of an option contract, and then we'll come back to this if there's still confusion. But I think the next part will clarify a lot of things for those that are confused. So I think I'm going to take Rick's suggestion, and I think we're going to roll with that. So there is a bunch of different properties of an option contract that have been kind of implicitly referencing, but been beating around the bush, so I don't have to give them in full detail without the visual aid. But let's talk about those in more detail. So let's talk about the things that make up an option contract. So this is an older screenshot. This is on Robinhood, which is a relatively common brokerage for those who might be new to trading. I know Robinhood is kind of like the default thing that people hop on when they start trading. So let's talk a little bit about what these option contracts are made up of. So first things first is the ticker, right? We have to pick a stock to be trading options on. And in this case, the ticker is SPY, right? So that is a ticker that we're trading options on. And anytime you're trading an option contract, it is based on an underlying equity. There's not any such thing as an option contract that's just some option, right? It's always based on some kind of equity. And in this case, it's based on SPY. And you'll see why the equity that it's based on is important. Next, there's a strike price. And this is the price where you can either exercise, or yeah, this is the strike price where you would exercise the contract. And this is what I've been kind of implicitly referencing and beating around the bush about. So for example, this contract, the strike price was 400. You can also see that it lists if it's a call or a put. In this case, it was a call. Here you can see the price that I paid for this contract. In this case, it's listed as 8 cents, but I'll tell you why it's actually didn't cost me 8 cents. You can also see the current price of the contract. You can see when it expires, and you can also see the amount of money that I've gained or lost on this position. So you might be wondering, why does it say this contract is 8 cents, but the value of it is $8? As we discussed earlier, option contracts give you the right to purchase or sell or forced to sell or forced to buy 100 shares. Every single option contract is derived from 100 shares. So when we're determining true price of the option contract, we have to multiply by 100. So even though this average cost was 8 cents, it actually costed $8, which you can see reflected in the market value. So the prices of options are listed on a per share basis, but the true cost is multiplied by 100. So unfortunately, we can't trade options for 8 cents. It's at minimum, the minimum you'll ever be able to pay for an option contract is really $1. But for the most part, that won't be something that you commonly do. But again, when you're looking at the prices of option contracts, it's always multiplied by 100. And we'll look at another brokerage that might display this in a bit more of a clear way. So I want to talk about just how option contracts look on another brokerage. This is TD Ameritrade. This is what I more commonly use. And that got resized wrong. And you can see how this looks a bit different. All the same information is mostly presented here, at least the fundamental information, but it looks a bit different, right? You can see here, we still have the ticker. We can see when the option contract expired, which happened to be almost 2 years ago now. The same strike price here, it lists as a call or a put. We can see the purchase price, the current price, and the current gain. Another interesting thing to note is here, it looks like the purchase price was $4.20 and the current price is $4.45. But if you look to the actual value of the contract, you can see that that's not the case. It actually is currently valued at $445 with a gain of $25, even though the gain looks like it's 25 cents. And again, that's just because option contracts are based on 100 shares. So you have to multiply this cost by 100. A lot of the times, this isn't something that is hard to get used to. You'll get used to it really quickly. I personally don't think it's weird anymore because I'm used to it, but I know some people that are new might look at this and think, Why? Oh, interesting question. So the strike price is not the cost of a stock. The strike price actually references, it's a property of the option contract. So essentially, this is what I was referring to earlier, and we can go back to that slide now. So now you kind of know what the strike price is. The strike price essentially says where the exercising or the assignment will occur, right? So remember that call buyers have the right to purchase stock if exercised, right? Let's just focus on calls because that's a little bit more intuitive, right? So remember, if I'm a call buyer, I have the right to purchase stock at a specific level. The strike price defines that specific level. So for example, on a stock like Zoom, the strike price that I was showing was $450. So if, for example, I'll just look at the Zoom chart at this time when I was actually trading this, which was a long time ago. But for example, let's say, well, hang on, let me make this clean so it's a little bit easier to see. So that $450 strike price lies right here. And I'll make it really obvious. So that thick blue line is where our strike price was, right around that $450. And I'll make it exact just so it's ultra clear. All right, so strike price was $450. Let's say I'm holding that contract and Zoom goes all the way up to 600, right? And I'm still holding that contract. If I'm a call buyer, I can now exercise that contract, which allows me to purchase 100 shares at $450 if I have the money to do so. And then ideally, I can sell those shares at this significantly higher price. Now, again, a few caveats to that. Now that you've learned a bit more, you might understand. So there's actually a break-even price with these option contracts. And you remember that you have to pay money to purchase an option contract. It doesn't just appear in your portfolio. So in this example, this contract was $420, right? So I paid $420. So my break-even on the stock would be $4.20 above 450, which equates to $420 on 100 shares. And I know that might be a little bit obscure, but if you think about it, I'm paying $420. That's a funny number. I'm paying $420 for this stock or for this option, right? So $420 is leaving my portfolio and it's going into the abyss, right? And in return, I'm getting an option contract. So let's say I want to exercise that contract when the stock is at 451, right? I'm in the money, right? So it seems like I should be making money, but you have to remember that if I exercise that contract, I get the shares at $450, no matter what, because that is the strike price. But if the stock's only trading at $452, I'm actually net negative on the position. Because if you think about it, I paid, here, let me write this math down so it's a little bit more clear. Let me pull up a notepad because that might help for those who might be a little bit confused when I start breaking up the math. Let's do this. Actually, let's pull up text. Sorry, I'm doing on the fly. Let's do some math. Okay. So again, strike price is 450, right? We're all clear on that. Option contract is 4.2 or 420. Stock price is, let's just call it 452. So I paid 420 for the option contract. And if I need to buy, or if I want to buy, okay, if I exercise this contract at $450, I'm forced to buy 450 or 100 shares, which means that cost me $45,000 to purchase 100 shares at 450, right? Because that's the right I get when I purchase the option contract. So just to recap, strike price is $450. The option contract cost me $420. So it was a $420 out of my pocket to purchase a $450 strike contract. The stock's currently trading at 452. And again, paid $420 for the option contract. Let's say I want to exercise it when the stock is trading at 452. If I exercise my contract, I get the shares at the strike price, no matter what. That's how options work. It doesn't matter what the stock is currently trading at. I always get the shares at the strike price. So it's going to cost me $45,000. But since I bought the shares at 450 based on the exercising of the contract, and this current price is at 452, that means I'm actually, my position is valued at 450 $45,200 current value because stock is at 452, but I paid 450. Is this making sense so far? Right? So we need to pay 45,000. Should have used smaller number for simplicity. Yeah, you're probably right, Tillia, but here we are. So did this on the fly. So it cost me $45,000 to purchase these 100 shares. Current value of the stock is $45,200 because the stock price is 452, right? I'm $2 up from 450. So right now I'm up $200 on the share position, but I paid $420 for the option contract. So I'm actually down $220 because I paid $420 for the option. My unrealized gain is $200, so I'm still down $220. So this is a little bit kind of bigger picture why sometimes it doesn't benefit you to exercise the option contract just because the stock price is trading above your strike. I don't even remember the question I was initially answering on that. Oh, is the strike price the cost of the stock? Does that make sense? Does that make sense? Okay. We don't have to break even if we trade it back to the market. I don't necessarily understand what you mean by trade it back to the market. Won't you be in profit as the premium goes up? Well, you have to remember that, yes, the premium will go up, but if you're exercising the option, you're not selling the contract. So you don't receive money back from the option. All you do is you're able to now buy shares at a discounted price. What would be your break even? It would be when the stock is trading at 450.5 or 450.4, because that times 100 is 45,400. Oh wait, it'd actually be 450.42, 420, and the option contract costed $420. Strike price is where you want the strike to get to, right? Like a target price for the call. Not necessarily. However, usually when you're trading, you want to have a strike price that's reasonable. So sometimes when selecting an option contract, you're going to select a strike that's reasonable. That could be your profit target. And there's times where this isn't the case and there's times where this is, but typically the strike price you choose when you're trading options should be relatively reasonable. A general rule of thumb is it shouldn't be too much further than 10% away from the current stock price. So let's say, for example, current stock price is $100. The strike price that I choose shouldn't be, if, for example, if I'm trading a put, it shouldn't be too much below 90. If I'm trading a call, it shouldn't be too much further above 110. Right? That's kind of a general rule of thumb that I like to provide. Again, there's going to be variable conditions where this rule doesn't make sense. And there's times where this does make more sense. And yeah, again, like Tillia mentioned, 99.99% of the time, we don't care about this whole exercising situation because most of the time we're not exercising options. We're just trading them. But this is just to give you background into the actual purpose of options and why they exist, besides a reason just to kind of flip and make some money on them. But does that kind of make sense to everybody and give a little bit more background into the true purpose? It may help with seeing actual profit you get with this example. In my mind, I'm getting this. If you say you got it at 450 and you sold it at 500, you get 5K in profit. Yes and no. So you get 5K in profit on those shares, but you have to keep in mind, you paid $420 for the option contract to get those shares at 450. So it's actually 5K minus $420. Does that make sense? That makes sense? Cool. All right, it seems like we're getting on the same page. Cool. All right, great. Is everybody doing okay? I know I'm kind of throwing the whole bus at you right now. All right. There's going to be some like pop quizzes as well. Well, I shouldn't say pop quizzes because I'm not going to kick you out if you get it wrong. All right, let's talk about some more stuff. So here's how to purchase an option contract. Oh, there's lamppost. This is just kind of a general guide as to what it looks like when you're looking to purchase an option. This is a screenshot from Robinhood. Again, it's pretty simple. You kind of click the option that you're looking to purchase. You can type in how many you want to buy. And you see that there's this bid and ask spread. And I want to talk about this very briefly. So the market is kind of like an auction in a sense, right? It's a tug of war between buyers and sellers. Buyers have something that they want to pay for something, and sellers have something that they want to get for something that they're selling, right? If you think about an option or an auction on like eBay, right? There's like a list price that the seller is looking to get, and bidders bid that price up until they can meet and maybe make a deal, right? That's the same way the option market works. So for example, again, this bid is what buyers are willing to purchase, and the ask is what sellers are willing to sell for. So you have to imagine that sellers are looking to make more money, so they're trying to sell it for a higher price, and buyers are looking to get a better deal, so they're trying to get a lower price. And that's why you see this spread in option contracts, right? So there's a little bit of a disagreement between buyers and sellers, and that's this spread that's created between the two. So it's important to note that if you're looking to instantly purchase an option contract, if you fill right at the ask, you're always going to get filled instantly. And again, that's kind of variable because sometimes the asks change right when you put in the order, and you can use a market order to mitigate that. But if you put in exactly what a seller is looking to get for their contract, you get filled instantly and you get the contract, right? You can also fill in the middle of these two, right? And that, in this case, wouldn't work because there is no middle, right? They're only a cent away and there's no in between that. But you can also put in an order in between these two, and on good brokerages, you can usually get a fill in between those two. So you don't necessarily get the best value, but you get in relatively quickly and you still get a good value in between the spread. If you're looking to get filled, if you're not in a rush to get filled, but you think you want to get a good value for some reason, right? Maybe you want to only pay the bid, you can set in a limit order for this bid. And you can also set a limit order for something completely outside of this range. So for example, if I'm looking to buy this contract at 0.5, I could put that order in and let it sit and it'll fill when it fills, or maybe it won't. Don't worry, JG is not new. That's Lambos if you guys see him around. He's not lost. But I appreciate the encouragement to make him ask questions. Is it always good to use limit orders versus market orders? A very interesting question. And I'll explain the difference between the two. So a limit order is what we're looking at right here. This is when you can put in a specific price, you set an order, and that kind of sends it in. A market order fills you instantly at the ask all the time. So if you send in a market order, you don't get to choose what price you're putting it in. It just fills you at the ask instantly. Most of the time for me, I'm always using limit orders. Market orders are something that I use relatively sparingly, just because usually I like to use a limit order because I can calculate my entry a little bit better and get filled exactly where I want to. Especially if you're trading closer to the open, using a market order can get you really heavily burned. And that was something that I learned the hard way when I market ordered a Tesla contract, probably close to 2 years ago at this point. And I was instantly down $100. And that was not fun. And that taught me a lesson pretty quickly that market orders can be very brutal. So if using a market order, you definitely have to be cautious, especially if the instrument you're trading has an incredibly large bid to ask spread. That means that your market order could fill you somewhere where you don't want to be filled. You could be down pretty big if you market order on something that doesn't have very much liquidity. And liquidity means a lot of people trading it. Do I use stop loss with Robinhood? I personally don't use stop losses on Robinhood. I don't really trade on Robinhood that much. So I don't exactly know how to set a stop loss on Robinhood. But if you are looking to learn about how to set a stop loss with like video examples, we have some for you. Let me just find them. It's in this brokerages tab. So there's a few kind of videos for you to refer to. If you scroll up like me here, you can see this video. This should show you how to set a stop loss on Robinhood. And there should be some on other brokerages as well. Like here's Webull and TOS as well, Thinkorswim, which is TD Ameritrade. Might be easier to understand the option buying concepts if I can tie it to a chart and then show the trade. Yeah, I can absolutely do that. Let's pull up an option contract and trade from today, just so I can show you how they move. So brief introduction, if you've never seen one of these charts before, I'm not going to go too far in depth into it, but this is essentially a stock chart. So this shows how the stock has moved historically, right? So this is a weekly chart, and each one of these little bars represents a week of trading data. That's about all the detail we're going to get into. The y-axis here is price. The x-axis here is time. That's true. Actually, we could talk about the Tesla puts. So the only trade I took today, I followed something that Tilio posted, which was Tesla puts. So we went short Tesla, I think right here, and we got some puts. And remember, when shorting or buying puts, that means that I want the stock to go down, right? So if I'm buying puts, I want the stock to go down. So let's pull that up next to the actual option contract. So it was Tesla contracts expiring this week. So that's 11 or 12:02 P175. All right, and let's look at how these contracts moved. Make it a little more clear. Cool. So this on the right is the option contract chart. So this shows exactly how the option moved throughout the day, and the time steps line up exactly the same. So we entered, you can see on the x-axis here, it shows the time. We entered at 9:30 in my time, which is 12:30 Eastern. So at 9:30 Eastern, these contracts were at about, I remember I filled, I think at like 1.4-ish, 1.44 maybe. I don't remember if that's where I filled. That seems a little low. Maybe. Let's just say I filled at 1.5. I think I actually did probably fill closer to 1.4. So here's the option contract. And let's just say for this example, you filled at 162, Tilio. I got a better fill than you. No, I actually did. I'll show you the execution later. I do actually think I got 1.44. So let's just say for purposes of simplicity, I got filled at 1.5. You can see the stock price was at a high here around 188. And the option contract increased in value to 2.3 by the end of the day, right? And as the stock price decreased, the stock price dropped $5, right? So that's a pretty good drop for Tesla. It's about 2%. The option contract increased 50% in value. Ooh, overlay them. I've actually never done that before. Let's see. It's going to be, it's a good point, Tilio. Tilio's giving me some tips, I guess. No, I've actually never done this before, so might as well see if that helps some people. Wait, saved as SPX. There we go. Okay, so now maybe this makes it a little bit simpler. This pink line is the option right here. So you can see, bought it here at a high, and as the stock price decreased, the option value increased, right? So that's kind of how this put option worked. You can see it definitely has a significant amount of power relative to a stock price. And I'll just show you kind of how that works again individually, so you can see the power of options and why they really can make a big difference in trading. You can make a lot of money quickly, and you can also lose a lot of money quickly if you're not careful. So let's take one last look at this. So again, just for your reference, let's just say for this example, I bought them around 1.5. It was relatively close. Stock price was at 180. The option contract, I think I sold first one right around here at 1.8. So this was about a 25% gain. Yeah, 20% gain from this level. So the option contract increased 20%, and I sold stock price right around this green oval. So stock price dropped 1% and the option increased 20%. So this just goes to show the power of options and how they're related to the stock value. You can see as the stock price or the underlying drops, the option contract increased in value, right? And for example, if I look at a call contract, you're going to see the same analog except the opposite, right? Because if you remember, call buyers are looking for the option value to go up. So this was the call at the high of day here, right around 9:30. And as the stock price decreased, so did the option value. Show the option trade and how and why I chose that trade. I'm not going to lie to you. I entered this trade mainly because Tilio mentioned it. I look at the chart, saw it was testing this high a day. It was an easy stop loss above this level. So I was like, you know what, I'll take two. Show why I trimmed at some levels. Yeah, sure. So I was at work, so I wasn't babysitting this trade. But as you can see, this alert is actually still here. So my stop loss would have been above 188.50, which means where I would have said that I was wrong on the trade, cut it and moved on to the next one. My profit target, I was looking mainly to this wick right here, this low. When I saw we broke below it and held below, I think when I checked the chart, it was finally right around here. I sold one right around here. Then I noticed this retest, kept holding for a little bit. And then I set my stop loss around 1.9, I think, or something like that. And it ended up hitting at some point. So again, right, different trade for me, considering that this wasn't one necessarily that I generated on my own. This was actually something that kind of everybody else would have done. Is if you're new, you might have been following an alert. So I had some of my own things that I was looking for. Tilio had some of his own things that he was looking for. But yeah, that's kind of big picture, kind of what I was looking for. I'm not expecting everybody to necessarily understand this, but just noticed that there were some buyers sitting at this 186 and some change area based on this wick. So that's when I was looking to take off my first one because I was expecting that could be some kind of bounce there. Noticed this retest, figured that that was fine to keep holding below after we gave up that level, and then let that ride for a bit with the stop loss just to protect some gains. Didn't want to see that get reversed. Does that kind of answer your question a little bit? Again, I don't want to get too far down the technical route just because I'm not necessarily expecting everybody to know what I'm talking about. So don't want to get too sidetracked, but hopefully that gives you a little bit of reference in that respect. And you might be wondering why that strike price, just something out of the money, betting on a quick move down. You had most of the market trending lower at this point in time. Tesla was the only one with relative strength. So just kind of a high risk trade. You either stop out really quickly or you make some money on a high risk one. If you take a look at the major market index, SPY, this one had just broken down right around this time, right at 9:30. Oh, not right at 9:30, but it had broken down, retested that breakdown. So you're kind of playing that high risk name, the only thing with relative strength into today, which should have, in theory, given you the most room to the downside, which ultimately it did. So again, just kind of that high risk name, something that you can use options to make it make sense. Cool. What's my preferred chart? If you put a gun to my head and told me I could only look at one chart for the rest of my life, it'd be the 1 hour for sure. But usually I'm looking at the 1 hour and 15 minute at all times. At least if I'm trading that specific stock, and I'll be kind of checking how the daily's looking periodically. Obviously, when I make my watch list, I look at the daily, the weekly, all that good stuff. But yeah, that's kind of my preferences. All right, so let's talk a little bit about what the option chain looks like and kind of what it's made up of and some more properties of option contracts. Here, again, you can see that bid and ask on these options. So you can see this is the Zoom option chain from a while ago. You can kind of see that bid and ask difference. And I know TD can be a little bit confusing to new traders. So just to kind of point it out, there's these headings here that let you know what each column represents. So there's this bid column here, ask column here. And this bid and ask is essentially that same spread that we previously saw on this Robinhood screenshot that shows what buyers are willing to pay and what sellers are willing to pay. One thing that I really want to note is you can also look at the volume and open interest. Volume and open interest are two very important properties of an option contract that if you're looking to purchase an option contract, you should absolutely take note of this, or at least know the instrument that you're trading. So let me define these two terms very briefly. Volume essentially represents the amount of this specific contract traded. And volume is a term that you'll see come up in multiple different ways in trading. You'll see volume on a stock, volume on options, volume on other types of equities. But volume represents how many of these contracts exchanged hands today, right? So if I am the only person buying an option contract and I buy 5 of them, the volume is 5. Simple as that. If I buy 5 and then Noam buys 20, volume is 25. If I buy 5, Noam buys 20, and Tilia buys 17, I'm not going to do that math in my head. It's like 42, but that's the volume, right? So that's how volume works. It essentially represents the amount of that specific thing that have changed hands. Open interest represents the amount of these contracts that existed as of yesterday's close, or actually today's open, technically. So open interest is going to change, and it's only updated every day at open. So that's going to change periodically, but essentially open interest represents how many of these contracts actually exist. So you have to imagine that option contracts don't just come from thin air, right? So people have to sell the option and somebody has to buy that for it to be considered one on the open interest, right? So open interest is how many of these contracts are actually sitting in somebody's portfolio. So let's say I buy and sell some contract 1,000 times, but I'm just buying and selling it to some person. And I don't know, I don't want to go too far down that, but essentially open interest is how many of these contracts actually exist, and volume is how many of these contracts have been trading. And you might be wondering, well, how can more contracts be traded than exist? Well, you have to remember that open interest is only updated once a day. So there could be more that have been sold that day and then subsequently purchased, which means open interest has increased throughout the day, but it's not reflected yet. And also, you have to remember that you can day trade these contracts. So you can sell it and buy it in the same day, or buy and sell in the same day. So again, that's just going to kind of avoid that once a day open interest calculation. So that's kind of volume open interest. And you might be wondering, why does this matter? Well, you have to remember, yeah, this is a good question that I'm about to answer. No, you have to remember, if I want to buy an option, right, it's got to make sense, right? There needs to be the liquidity or volume and open interest that exists for me to be able to easily purchase it. But more importantly, I need to be able to easily sell this contract. Because if you think about it, right, if I'm buying this contract and then later going to sell it, I want to be able to sell and take my profits, right? And if there's no volume and no open interest, that means there's no buyers, right? So if there's nobody who wants to buy this contract from me, who am I going to sell it to, right? So the only reason that this works is somebody's going to buy it from me, right? And if there's no volume and no open interest, that means that contract is not reasonable and not many people are going to be interested in buying it. So very important to take a look at that if you're trading a stock that you haven't before or you're not used to it. There's some stocks where for the most part, you never have to worry if you follow that kind of 10% rule. So for example, something like Apple, you never have to worry about the volume and open interest unless you start going like 10% away from the current price. Then you need to start considering what the volume and open interest is. But you have to think about everybody's trading Apple, right? It's a very popularly traded stock. It's a very important piece of the market and very commonly traded. So Apple, you're never going to have a problem with that. Some common numbers that I look for. And again, volume and open interest depends on the stock. It's important to note that different stocks have different volumes, and some volumes might be great for some stocks and some volumes might be low for others. So I'll actually pull up the options chain. It's right here, and we'll take a look on SPY. And not everybody's going to see this if you're on mobile, so I'll try my best to read it out loud. So for example, some contracts on SPY have 288,000 volume today and 14,000 open interest. This is great. You're not going to have any trouble buying and selling this, right? But a contract with, for example, 13 volume and 165 open interest, you might have an issue trying to buy and sell that contract. But for example, on a stock like Apple, you're not going to have 200,000 volume, right? So here on this contract, you only have 500,000 or 5,000 volume, which is still just fine, right? So my general rule that I like to look for is about 1,000 volume. And again, it's so variable. It depends on the stock. There's going to be some names that are a little bit more illiquid that you just have to pick the highest one, like 250 volume, 300 volume. So for example, a stock maybe like Airbnb, going to be a little bit less volume, right? So for the most part, these close to the money options are like 500 volume, 200 volume, right? So not really anything amazing except this 2,400 volume. So you're going to have to take one of these contracts, right? And I mean, again, this is 2,400 volume. That's just fine. And open interest, I usually like to look for at least 250. Again, super arbitrary. It all depends on the stock. We could go through this. We could look at different stocks and say what looks good, what doesn't look good. Well, for example, on a stock like Airbnb, this 79 volume, 184 open interest is no good for me. That's not something that I'd be interested in taking. And I'll show you why this can be so significant. If we compare some of these contracts, you'll see that these bid and ask spreads change based on the amount of volume and open interest. So for example, this 302.50 strike price contract has a $50 spread, whereas this 305 contract has a $30 spread, meaning the bid and ask have $30 difference or a $50 difference. And if you refer to the volume and open interest, you can see that the 302.5 strike has a lot less volume and open interest than the 305, which means that there's less people interested in buying and selling the contract, which widens the bid and ask spread. So if you think about it, if there's less people and institutions that are interested in trading a contract, it's going to be harder to get those bid and ask closer to each other. So again, that's how volume and open interest can actually influence your contract choice, what makes the most sense for you. But again, this depends per stock. If you're trading something like SPY, Apple, Amazon, Nvidia, for the most part, this will never be an issue, right? Even your Ford, AT&T, Coca-Cola. If you're kind of within that 10% away from the current stock price rule, you're really never going to even notice it. But some different names, like even the ZM, Airbnb, right? A little bit more of obscure names, less frequently traded, you're going to notice that bid and ask spread. So I'm going to take a quick break and just check in with everybody because I know we've been going through a lot. We're an hour deep already. So how is everybody feeling so far? We haven't even got to the Greeks yet. But how's everybody doing so far? You guys can let me know in the chat. Been good. Brain running hot. Cool. All right. Tilio just ordered a strap. All right. Cool. We all doing well so far? Any questions so far? Volume gets updated as contracts are trading. Open interest gets updated once a day. Just to reiterate, we need trades with higher volume than OI. Not necessarily, no, but that can be kind of a more advanced thing to look for. If you see volume greater than OI, it shows there's a lot of interest in a specific contract. So you don't need your contract to have higher volume than OI. You can't find the spot where there's an example of how to place a stop loss on TV. It's in this brokerages tab right here. So under education, go to brokerages, and it's right here. And it's in this tab. And if you can't find it, send me a DM and I'll send you the link. Or actually, I'll just DM you right now on Zoom and send you the link. So if you click that link I just sent you, Reginald, you can go straight to that. Has anybody stop loss not hit before? Certainly, yeah. A stop limit can definitely get skipped over because it's a limit order. So if the option's moving really quick, sometimes you won't get filled. Usually I use a stop market when I'm trying to put a stop loss on the books, which is pretty rare, but if I'm using a stop loss, it's usually stop market. So no matter what, I'm going to get stopped out if I place that stop market. And yeah, we have not covered the Greeks yet, but we will get there in just a little bit. All right, let's talk about a few more terms. I want to talk about in the money, out of the money, and at the money. So an in the money contract is when the stock price is higher than the price of the call contract. So for example, if I'm in a 90 strike call contract and Apple's trading at 95, the contract is in the money for a call contract. For an out of the money contract, the stock price is lower than the strike price of the call contract. Oh, wait, the stock price is, wait, that's wrong. Why is this backwards? What is going on here? Stock price, that's wrong. This is out of, what am I doing here? How have I gone this long with this looking like this? What? Oh, okay, so the example's right. Sorry, I'm freaking out right now. I don't know why this is wrong. Okay, sorry, I had to fix that. I can't believe that that's been wrong for so long, and I just noticed it now. So an in the money contract. An in the money contract is when the stock price is lower than the strike price. Oh, wait, no, that was right. I'm totally tripping myself out right now. I'm thinking of puts. Wow. Geez, I'm losing it. Okay, sorry about that. So an in the money contract is when the stock price is higher than the strike price of the call contract. So if I buy a 90 strike call contract and Apple is trading at 95, that contract is in the money, meaning that the strike price is below where the stock is currently trading, or the stock is currently trading above the strike price. For an out of the money contract, the stock price is lower than the strike price of a call contract. So for example, if I'm in that same 90 strike call contract and Apple is at 85, that contract is out of the money. And for an at the money contract, the stock price is equal or very close to the strike price of the call or put. So if I have a 90 strike call contract and Apple's at 90, that contract is at the money. Sometimes you'll also see an 89 strike or a 91 strike when Apple's at 90 be considered at the money as well. It's usually that first adjacent strike or the one that it's trading on top of be considered at the money. And let me give you guys a little bit of a visual of what that kind of looks like. So we're going to go back to the Zoom options chain. So here, Zoom is trading at $299. So these calls above $299 for the most part are going to be out of the money, right? Because the stock price is not above the current contract. And you remember that when we talked about our example of exercising contracts, usually it makes much more sense to exercise a contract that's in the money rather than out of the money, because that's when you're actually in profit on your shares. So these contracts above this 300 strike are out of the money. The at the money contract is 300 strike or maybe even the 297.50 strike, because it's the next two strikes outside of that 300 range, right? So the stock is trading at 299. So the strike price closest to that to the upside and the downside are going to be our at the money contracts. And then finally, our in the money contracts are all going to be below where the stock is currently trading. So our 295, our 290, our 285, those are all in the money. And for puts, out of the money and in the money is the exact opposite, because you got to remember, puts we're expecting the stock price to go down. So essentially out of the money contracts are when the stock price needs to move in our favor for the price or for the stock or for the contract to come in the money. Sorry, I'm losing it an hour deep. So the out of the money puts are the exact opposite of the out of the money calls. Or another way to think about it is out of the money puts are in the money calls. So for example, again, stock price is trading at 299. So out of the money puts would be 295, 290, 285, right? Because the stock price needs to drop for us to go in the money. At the money puts and at the money calls are always going to be the same strike price. And then in the money puts are above the current stock price. So again, current stock price is 299. In the money puts are 305, 310, 315, right? So this might be a little bit abstract. So I'm going to quiz everybody's understanding to see how you guys feel about this so far. So let's talk about this. I'm going to give you guys a few scenarios and you guys are going to let me know what you think. We're going to start it off decently easy. So I have a call contract of SPY. Pay attention to the type of contract I have. Call contract of SPY, the strike price is 395. SPY is currently trading at 412.24. Is this contract out of the money, at the money, or in the money? What are you guys' thoughts? Throw them in the chat. And even if you don't know, let me know. Okay, so we have one answer for in the money and out of the money, another answer for in the money. Okay, so it's a little bit mixed, a little bit mixed, a little bit mixed. All right, so it's looking like we have a little bit more agreement on in the money. And I would agree with the in the money people. So just to recap, let's go back to the previous example. Remember that in the money calls are below the current stock price. So if the stock price is 299, our in the money calls are going to be below that current stock price. So 295, 290. And if we look back to this example, the current stock price is 412, but our call strike is 395. So it's below the current stock price, meaning it is in the money. For those of you who said out of the money, does it make sense why that is not correct in this example? Tilio got it wrong too, so he blew it. Fat fingered. That's fair. But for those who got it wrong, does it make sense why? Yeah. Okay, is there any confusion? Because we got a few more questions. Two more. If there's any confusion, let's hash it out now so we get even more right answers on the next one. If not, forever hold your peace. All right. In the money because it's gone past the strike price. Yeah, exactly. But you have to remember that calls and puts are opposite. Okay, let's do another example. You have a call contract of SPY. The strike price is 412 and SPY is currently trading at 412. Is this contract out of the money, at the money, or in the money? What do you guys think? Seems like we're thinking at the money. I would agree. Yeah, I would agree. That was an easy one. That was an easy one. Okay, the next one, read the question carefully or listen carefully, because every time I do this lecture, a good portion of people get it wrong just because they don't realize that something changed. Here we go. I have a put contract of SPY, a put. The strike price is 420. SPY is currently trading at 412. Is this contract out of the money, at the money, or in the money? Ignore what Tilio says. Oh, we're mixed. Okay. Give some reasoning. If you guys think out of the money, why? Or if you think in the money, why? I'm not going to say what's right yet. I want to see one reason for both. Tilio, you're not helping. Not helping. So this one is actually going to be in the money. Again, this is one that can be relatively confusing. Did I clarify? No, I didn't clarify that, I guess. Okay, I have a put contract to SPY. Strike price is 420. SPY is currently trading at 412. So if we take a look back, remember that if the strike price is above the current stock price, it's in the money if it's a put, or out of the money if it's a call. Yeah, 412 is less than 420, in the money, pretty much, right? That is an in the money put. Again, I know this concept is a little bit obscure, but I hope these examples helped at least think about it. And if you got it wrong, you can continue to message me and we could talk through it a little bit more about it. Yeah, I'll show the question one more time. Put contract to SPY, the strike price is 420. SPY is currently trading at 412. So the strike price is above the current stock price. So this contract is going to be in the money. If you're colorblind, it might have made this one a little bit more difficult. Tilio's being dumb. All right. So we're starting to get into some more advanced / confusing stuff. You should be out already. That's a good point, Douglas. Yeah, you shouldn't be in this contract anymore. You should be out of there. Good point. Good point. All right, let's talk about how an option premium is actually determined. There's two main components to an option contract's premium: extrinsic value and intrinsic value. And also, I think I'm probably, just to let you guys all know, I think I'm probably going to tack the Greeks on to the next lecture because I don't want to rush through it. And if we tack the Greeks on to the end of this, we'll be done in like another hour. So I'm going to tack the Greeks. I'm going to do the Greeks next lecture, so I can go in more detail. So if you're waiting around for the Greeks, I'm not going to like bait you. I know somebody was over here for the Greeks, so I'm sorry. But let's talk about how an option contract is actually made. Yeah, I've been working for free all day. I've been on my smoke break. So two main components that make up an option contract: intrinsic value, which is time value or implied volatility, which we'll define more in the next lecture, and intrinsic value, which is the amount the contract is in the money. This, when I first started, was something that I had difficulty remembering. And the way I remember it now and learned it is I think about intrinsic value as the reason the option contract exists. And I think about being exercised. And it only makes sense to exercise the contract if it's in the money. So intrinsic value is the amount the contract is in the money. I don't know if that's going to help everybody remember it, but that's what helps me remember it. So yeah, intrinsic value is the amount the contract is in the money. And extrinsic value is things that aren't related to the necessary purpose of the option contract. So it's things like time value, which is the time to expiration, and implied volatility, which we'll define more later. So let's kind of calculate and learn how to calculate the makeup of an option contract. So let's go back to our example when we talked about our call contract to SPY. The strike price is $3.95 and SPY is currently trading at $412.24. So the ask price of the contract is 24.59. And again, this is completely hypothetical, completely fake, but totally can be used in the real market. Also important to note that most of the time, you're not really going to be calculating this. But again, if you want to understand the fundamentals of options, this is all part of it. So this is actually something funny. When I took a college class that involved options trading, this is something that we talked about. So I figured if I'm trying to make this accurate, I should probably talk about this as well. So IV stands for intrinsic value, EV stands for extrinsic value. To calculate the intrinsic value, all we need to calculate is the amount the contract is in the money, because that's what intrinsic value is. So I subtract the strike price of the contract from the current price of the stock. So 412.24 minus 395. And again, we always multiply by 100 because the contract is not $24.59. I wish it was that cheap. It'd be great. We would have so much fun around here, but it's actually $2,459. So to compute our intrinsic value, we subtract the strike price from the current price of the stock. We multiply by 100. That gives us an intrinsic value of 1,724. Then to calculate the extrinsic value, there's not necessarily a simple formula to calculate that on its own. So we just subtract the intrinsic value from the total premium, and everything left over is extrinsic. So in this case, the contract costed 24.59. We multiply that by 100, which gives us 2,459. We subtract the intrinsic value, which we calculated is 1,724, and we get 735. Does that make sense? Does that make sense, everybody? I know Tilio, he didn't make it through third grade, so this might be a little bit difficult for him to understand the math. Subtracting is a difficult thing for him, so give him a bit of a break if he has some trouble figuring that out. We'll do some tutoring for him later. Yeah, I can repeat again. Oh yeah, this is okay. So correlation between premium and IV. So implied volatility is essentially what the options market and the equities market in general is expecting the stock to do typically within the next 30 days. So for example, if the market thinks that the stock is going to be especially, well, it's not typically within the next 30 days. It depends on the option expiration. The 30 days is for the VIX. So for example, if a stock has an earnings report, the market knows that it's going to move a lot on that earnings report, right? And if you guys have ever like watched news on the market or followed a stock before, you'll know that usually when they report earnings, a stock moves based on that, right? Because investors know how they performed over the past quarter and they have an idea about how they might perform in future quarters and years, right? So when earnings is coming up, IV increases because the market knows that there's going to be a big move in the stock. So as the anticipation of volatility increases, implied volatility will increase. That's kind of how the option market protects itself from that. or prices that in, I should say. So correlation between premium and IV. As IV increases, stock or options premium increases. So you can imagine that you don't necessarily want to be buying contracts on very high IV because they're going to be more expensive. Like, for example, when that whole AMC squeeze thing was going on and people were buying contracts with 500 to 600% IV, it was like giving me a headache. And thankfully that time it worked out. But for the most part, that doesn't make any sense. You still made money. Yeah, exactly. Exactly. Well, that was the first time you could have made money on that. And like, I mean, I guess HKD too. Might be getting out of topic here, but that's also sounds like futures. I don't think there's intrinsic and extrinsic value with futures. I don't exactly know how futures are priced, but I know how they move. So I can't specifically speak on how their price is derived. Well, I guess futures options, I should say. Futures are just based on the actual price of the futures contract, which is based on the index, or I guess kind of correlated with the index, I should say. So futures kind of isn't priced. Usually brokers just have margin requirements for futures, and that's the price. But there's futures options contracts, and I don't know much about those and don't know anybody that trades those because those are pretty obscure, but it's something. But if you want to talk more about it, or maybe if I misunderstood the question, you can follow up with me. It's okay. Okay, yeah. Futures are priced based on your specific brokerage's margin requirements. Futures options are a completely different animal. I'm not sure. I think they might act like similar options. Like they might have Greeks because they have expirations. So how does intrinsic value or extrinsic value apply to picking a strike price? Okay, so this calculation in specific doesn't apply to picking a specific contract. Like for the most part, you're not really going to be doing this full calculation and being like, okay, I got 200 intrinsic value. I'll probably buy this one, right? But there is times when you want to have intrinsic value on a contract for other reasons than just wanting, to calculate this. For example, if you want to purchase an option, but you think that the stock might move out of your favor, you might want to buy something that's in the money because it's going to hold its value a bit better, and it's going to continue to be reasonable if the stock price moves away from that value. So for example, if the stock is currently trading at 360, but I think it might rip, I might buy a 370 put just in case it does rip to protect myself, right? And you might be wondering, well, if you think it's going to rip, then why are you buying a put? Well, you have to be prepared. Maybe you're trying to bet on a quick flush, and if you don't get that quick flush, it's going to be a big rip, but it'll still pay, so you buy the time. So for example, again, let's say stock is trading at 360. I buy, I don't know, a 370 strike. If the stock goes to 380, that contract's still reasonable, right? It's still $10 out of the money. It was $10 in the money, but it's still reasonable, right? It's not too far away from the current price. Whereas if the stock was trading at 360 and I buy a 350 put, now when the stock's trading at 380, that 350 put doesn't make any sense anymore. It's completely unreasonable. It just doesn't make sense. So that is why you can use, or that's how you can use quote unquote intrinsic value to your advantage in specific trades. More of an advanced thing to think about. However, that is how this can be useful in picking option contracts. Does that answer your question? Yeah. So that is one way to protect yourself from kind of the choppiness, is maybe buying something in the money. You could also just add more time and still kind of keep it out of the money, which is what I've been preferring, is usually just buying some time or staying away from weeklies for the most part, just because we're kind of range bound. There's not too much of a point for me to be going heavy in much of anything. So just adding some time can also perform a similar form of hedging, if that makes sense. Cool. All right, so just to list a few, I skipped one. Just to list a few advanced option strategies that we kind of referenced but didn't talk about tonight. Selling premium. So again, this is all about selling to open calls or puts, right? So we alluded to it briefly, but we didn't get into it. That is a whole nother lecture that we could talk about for, an hour or two. So that's a whole nother lecture. And selling premium includes types of spreads as well. Not expecting you to understand what I'm talking about, but just putting these terms in your head. So maybe when you see them again in the future, you're like, oh, I know that exists. Maybe I want to learn more, right? So debit spreads and credit spreads can be ways to trade options as well and minimize risk. There's also advanced option strategies where you buy 4 option contracts or a mix of buying and selling different option contracts for one position. So that can be like an iron condor or a straddle or a butterfly, or, you guys probably think I'm joking with all these crazy names, but I swear I didn't pick them. I'm just here and following them. But yeah, so bunch of advanced option strategies as well that we are not covering, but just letting you know they exist. They're a thing. Again, we didn't even make it to the Greeks tonight. So if I were to go into these, we'd be here till midnight. So I'm going to wrap it up here on this slide. Let's talk about some questions that you guys might have. I'll give you a brief introduction into what next lecture is going to look like. It's probably not going to take the whole time to do the Greeks, so we'll probably do a little bit of Greeks, and then we'll get into, I don't know what I have planned after the Greeks. Probably it'll be a mix. We'll probably talk a little bit about Greeks, then we'll talk about setting up kind of charts, just looking at the basics of charts, and then we'll start probably talking about candlesticks, if I had to guess. Will we cover straddles by the end of the course? I am not by any means the expert in selling premium. I am familiar with selling premium and multiple selling premium strategies and have done it myself. However, in most of those strategies, they aren't something that I use ever really. So I wouldn't consider myself to be qualified to speak on those topics. So I will not be talking about straddles. However, we do have lectures to reference on selling premium in general. So in that case, I'll defer to our selling premium analyst phase. It's kind of his job here to sell premium. So I'm going to let him handle all that. But I think what we could do is, we could just have him, come in as a guest to talk about some basics of selling premium to spark your interest maybe. And I could do that. I could talk about the basics, but I think I'd rather have him do it just because he's literally selling premium today, whereas I haven't sold premium in a few months. So yeah. Will trading psychology be talked about at some point in the 8 weeks? 100%. That is arguably the most important concept behind trading. I would like to think that 10 to 20% of trading is technical and 80% is the head you got on your shoulders. Oh, that was probably stupid, but it's so important to be paying attention to your psychology, having great habits behind trading. So I'm going to show you guys some of my habits, and I'll talk to you about some of the mistakes that I made as well, because hopefully you can learn from that. A lot of the times I've noticed that people don't learn from my mistakes. They just have to go make them themselves, and then they learn, which is sad, but kind of just how things work. So we will definitely have a trading psychology lecture. I'll do my best to get multiple guests on there as well, so you can get different perspectives, because I think that could be really useful. And I love having multiple analysts on here. I think it provides more value to all you guys as well. So yes, we will 100% cover trading psychology, and that will be arguably the most important lecture that we have. Will the recording be available later? I have to confirm that with somebody. I don't know if it's going to be available tonight, but it will be available later sometime this week. Does that make sense? Not trying to jump ahead, but will we cover back testing? Back testing in general, yeah. I don't have a specific lecture plan on back testing in general, but if you think about it, like a lot of the things that I'm going to cover are a form of back testing, and you'll hear me kind of repeat these phrases, but I always remind everybody that anybody can look at a chart and say, oh, look what you could have done, or look where you could have bought and sold the perfect entry, right? And obviously I'm not doing that. Nobody's doing that, right? Nobody's getting the perfect buy and sell every single time. However, it's very important to review things that have happened in the past, reasonable entries and reasonable trades, and learn from that, because patterns in the market and trades in the market always repeat, right? There's different cycles in the market that repeat. There's different reactions in the market that repeat. So many things in the market repeat time and time again. I was just looking at a chart from 1918 that looked like it could have been from, a rip after the COVID crash. So, let's see if I can even find it. I don't even remember. It was, oops, I didn't mean to open that. It was BT. I don't know. They probably went bankrupt. It was Bethlehem Steel. Yeah, if you wanna look up, they're probably bankrupt. They probably got bought out or don't exist anymore. But Bethlehem Steel, if you look at that chart after World War I, it's very, very interesting to look at that. That chart rallied 400%. And it's just very interesting to look at how these patterns have always existed in the market. Just these concepts behind price action and the things that we're going to continue to talk about in much more detail throughout this course. So, it just goes to show that these things have been around for 100 years, 200 years. Nothing's changed with the whole computerization and of the world, and I guarantee you it's not going away. So, well, I shouldn't say guarantee. Nothing's guaranteed. Maybe the market will be done tomorrow, but important to note that history is very important to be studied in the market, and that is how you learn and prepare for the future, is looking back at history, reviewing your historical trades and learning from those and taking notes and things like that. So that was a little bit of a rant, but hopefully that kind of makes sense. Would love to see the 2008 crash data. I'll probably do a lecture on that. I did one lecture on bear markets in general, and considering we're currently in a bear market, I'll probably repeat that one, because that one I'm sure could be pretty useful for everybody. So yeah, we can talk about that as well. But yeah, I think from here, everybody, we're going to wrap it up. For those of you who have stayed throughout the whole lecture, I really appreciate it. And I always want to remind everybody that these lectures are nothing without the members that join. I can't sit here and talk to myself. It's no fun for me. So all your questions and your engagement makes these lectures what they are. So I really hope to see you guys all here throughout the next few weeks. If this is your first lecture here at Only Options Trades, I really hope you enjoyed. If you didn't, or you would like to see things change in the future lectures, I'd really appreciate it if you sent me a message and let me know how I can change things and how I can improve things for you in the future. And if you have any questions that you didn't get answered tonight, or you were too nervous to ask, or whatever it might be, feel free to reach out with me with a DM. I'll get back to you as soon as I can. But yeah, thanks again, everybody. Welcome to everybody who's brand new to my lectures and to the server in general. It's a pleasure to have you again, and I hope to see you guys all here next week. Keenan, one more question. Yeah, drop it in my DMs. And any last questions, go ahead and send them over. You're still a little confused on the in the money for and out of the money for calls and puts. Can I explain it one more time? Yeah, let's go back. So I'm using this reference just because I think it might be useful. Oh, to Keenan's. Sorry, Keenan sent me a message. So only thing, this is kind of a memorization thing too. So if you don't get it right now, it might just be because you need a little time to like actually let it sink in. And we also discussed a lot tonight too. So don't like feel bad if you're not getting it. Trust me, I know we covered a lot. And if I was brand new today, I'd probably be a little overwhelmed. But in general, big picture, right? Out of the money calls are above the current stock price. Out of the money puts are below the current stock price, right? So out of the money calls are above the current stock price. Out of the money puts are below the current stock price. Out of the money and in the money are exact opposites. So if out of the money puts are below the current stock price, then in the money puts have to be above the current stock price. And if out of the money calls are above the current stock price, in the money calls have to be below the current stock price. So all you really need to know is one thing. If you know one of these things, you can get them all if you like write it down. So for example, if I know calls are out of the money, if they're above the current stock price, I'll be able to figure out the rest, right? Because I know, okay, if calls are out of the money above the current stock price, then puts have to be out of the money below the current stock price because they're exact opposites. That's a different way of thinking about it that I didn't talk about in the lecture. Does that maybe change how you might think about it at all, or does that not really help? I also might not have the best graphics for this specific concept as well. So if you still don't understand, that's not a problem. Just feel free to send me a DM so I know who you are on Discord, and I can try and find some more different ways of presenting it to you. Yeah, no, if you still have any more questions, just feel free to reach out and let me know. I don't mind explaining it in different ways. It's just, this is the best way that I've had to explain it in the past. But again, like I mentioned at the beginning of the class, one size does not fit all. There's going to be different things that click for other people. So don't feel bad if you didn't get it. This is also in the PDF under beginners. Yeah, there's that beginners PDF is great. All right, everybody. Yeah, thank you all so much for attending. I appreciate you staying with me through the whole class. This was a really long one. And yeah, I'll see you guys all on the trade floor throughout the week and in lecture next Monday. Thanks again, everybody. Have a great rest of your evening. Adios. Take care.